Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. Here at ADISA, we're focused on thought leadership and insights, all relating to alternative investments. My name is Greg Mausz. I'm your host today. I'm joined by Dwight Dunton, and he is the CEO of Bonaventure. Glad to have you on the show.
Yeah, I'm really excited to be here. I've watched a number of your pieces. This is a really exciting opportunity. Thanks for having me.
Absolutely. Today, I want to talk about NAV REITs,
Sure.
Why they're still relevant, why they should be a focus and a core part of portfolios. As we dive into this, can you kind of talk through the evolution of the non-traded REIT over the last couple decades?
Absolutely. I think the first thing to understand is the REIT is just a wrapper. It's a special corporation that Congress set up to allow real estate assets to flow through all their income to the owners rather than having double taxation like a traditional company. And they started out really with a boom of private companies going public, mostly in the 70s, 80s, and 90s. Then in the early 2000s, there was a group of real estate sponsors who said, hey, let's take the benefits of a REIT along with life cycle funds that had a finite life, and let's put those together and see what we can do. And I think it was a great idea because there was a lot of benefits of both those vehicles, but there are also shortcomings. And those shortcomings mainly showed up when that REIT had one exit plan, which was to sell in 5 years, and the economy was down, or interest rates were up, and so values of those assets were down. Or their plan was to go public, take that private REIT and publicly list it, but the stock market was down rather than up. And so those vehicles didn't have a great exit because they only had one plan baked in. And so the publicly traded REITs, they're evergreen vehicles, and so they can just wait through those times. Whereas these private, non-traded REITs, in many respects, they didn't have the ability to wait. They had to exit because that was in the fund setup documents.
Right, and that's really problematic. And when they set up the funds, they're set up as 5-10-year funds, and who knows what's going to happen in that time frame.
I hardly know what I'm having for breakfast tomorrow, much less what the economy is going to be doing in 5 years.
Exactly. So we now have this more modern solution of NAV REITs. Yep. Does that fix the problem?
I think it goes a long way, because one of the things about, if you think about being a real estate owner, if you owned a house and you moved up, but you kept the first house, you held that for years and decades, and it grew in value. And so you decided to exit at a time that worked for you and your family rather than the sponsor of the fund. But also, you think about the shortcomings of a publicly traded REIT, which is those values fluctuate every single day on the stock market, and it has nothing to do with the underlying fundamentals of the real estate. So if you take the goals of saying, how do we pass through income? How do we allow investors to hold based on their time frame and their family needs? You get the current version of NAV REITs. And those really allow for alignment and with the investors' long-term goals, allow alignment for the sponsor to make business decisions about what's right for the portfolio, what's right for the economic cycle, but then disconnect the decisions for your family, my family, the sponsor's decisions, so that everybody can start making independent decisions of when they want to add capital, take their dividends. Some of these programs have dividend reinvestment plans, but then they also have limited liquidity. So you can decide as an investor, hey, I got to send my kid to college, and so I'm going to redeem some of those shares, which is a huge benefit versus owning a house. You can't sell part of a house very easily, but you could certainly sell some of those shares.
So you brought up liquidity. That's a key feature. A lot of them are like a 5% per quarter liquidity. And a lot of times that's fine, but sometimes it's not. And sometimes there's gates that are hit or prorations that are hit. What would you say to advisors and investors that are worried about that limited liquidity?
Well, I think using the word limited in front of liquidity is probably the most important thing in this conversation. And I oftentimes hear people omit that first word. They just say liquidity, that it's like a stock. You can just send your paperwork in and it's going to get redeemed. And I think that has created a situation where some investors, for whatever reason, they either missed the word liquidity or they weren't told or limited in the liquidity conversation. And so they thought that they could just redeem every quarter. I think that that's the most important part. It's a limited liquidity tool. The underlying assets are very hard to sell. Apartment buildings, which is what we do, that's the most liquid real estate market, and it takes at minimum 60 days and probably 120 days to sell an apartment building. And so you have to remember that the underlying assets are somewhat illiquid, so it's a fallacy to think that the shares can be liquidated instantaneously. And so that's why a lot of firms have set guidelines about, say, 5% on a quarterly basis or 1% per month as a guidepost. But the problem is a lot of investors all tried to run for the exit at the same time. And we saw that acutely occur when interest rates went up 500 basis points and people said, gosh, I can earn more in the bank than I can on the dividends. And so everyone ran to the exit at the same time.
And so, is there a solution to that?
Yeah, I do think that the guidelines that firms have set up for how much aggregate liquidity in a time frame is important for all investors, because if there wasn't, you could have the assets liquidated at really low prices, and that would hurt everyone.
True.
Not just the exiting party, but the folks who didn't want to sell. And so I think that's an important tool. But I think it's education. And if a client or an investor needs immediate liquidity, maybe a private non-traded REIT or public non-traded REIT is not them. They should buy the publicly traded brethren.
Right. Or be properly diversified among multiple different vehicles, multiple different time frames, so that investments are becoming liquid at different times, or may not have a run on the gates there.
Yeah, so. I do think that asset allocation is key. Real estate can form a piece, and it's really important piece because of its non-correlated relationship with publicly traded markets. Mm-hmm. But it needs to be in perspective, and it needs to be a thoughtful approach to how you manage your current needs and your potential future ones, and then have the ability to access capital in an emergency. And this should not be on that emergency list.
Right. So in a previous video, we had a discussion around the alphabet soup of share classes that a lot of these REITs have, and sometimes they're custom, but they've come up with a whole breadth of different expense ratios that meet different firms' needs, which is great. But we are seeing a rise in assets moving from brokerage accounts to advisory accounts.
Yep.
Can you make a case for why these NAV REITs should be in advisory accounts?
Sure. First of all, I think that transition follows just assets in general. There seems to be more assets moving to the advisory from the fee-based accounts. So I don't think NAV REITs are particularly special in that migration. But what I will say is that because the NAV REITs do have that limited liquidity feature versus, say, a life cycle fund, that gives the ability to the advisor and the client to trim positions, add to positions, and therefore you don't have to overcome that initial commission that you paid. And so if your plan was to hold a position for 10 years, but in 5 years you trim it, that's okay. You didn't lose a lot of money on commissions because you didn't pay when you're in an advisory account. And that really frees, I think, clients and their advisors to make decisions in the moment that maybe were different than what they thought several years before, versus saying, I really feel like I have to stay in this because I did pay this load and there might be a surrender charge for one of those share classes.
Sure. Well, I also think the key factor for advisory accounts is valuation, right?
Yeah. So that is probably one of the most interesting double-edged swords in the non-traded REIT space is, I look at our portfolio and, today, I don't think the values of those buildings changed. But I do know that the publicly traded REITs that own buildings across the street from us, their shares change in price today. And so that is one of the reasons folks want to own the non-traded version, is because of the volatility goes away of public markets. Right. So that's the positive. Potential negative is you do have to create marks because there is periodic investments, like every month there might be new admits. What's the price of those shares? If you participate in a redemption, what are those prices that you get repurchased at? And so valuation becomes really important, and that's where the devil is in the details. And you really have to talk to the sponsor and understand what the valuation method is. How much is internal? How much is external? Is it audited? Is it attested? Are there annual appraisals? Are there quarterly fairness opinions? So that ultimately you can feel confident that the price of the NAV REIT reflects the underlying value of the real estate. And I think a lot of firms do a great job, and others, I think that the market has said they're not comfortable with their approach.
No, 100% from the real estate side, but from the RIA side, they need to make sure that they're billing their clients on the proper valuation for that investment. Yep. So they need those monthly or quarterly marks so that that valuation is properly reflected on the statements.
Absolutely, and I think that's where selecting the program that has a valuation methodology that advisor says, I feel really confident that represents the fair value of those assets so that they're effectively charging their clients appropriately.
So make a case. Why should advisors really look at making NAV REITs a core part of their alt allocation?
Yeah. So I think everyone understands real estate. We drive by it every day. We shop at it. We sometimes go to work at it. We certainly live in it. And so I think it's a comfort level for lots of investors is they can touch and feel it. And I think part of the goal of advisors is to make their clients comfortable. And when you can say, hey, part of your portfolio is something you can relate to, that's important. That's on the qualitative side. On the quantitative side is the returns over long periods of times have been very good in U.S. real estate. Also, they're uncorrelated with largely with public markets. And so you're able to get returns that are not correlated with, say, your public stock portfolio. And I think that's really important for clients, especially as they get closer to retirement, where they are going to have to make withdrawals, and to have a large drawdown in their portfolio would be really unfortunate timing. And so I think real estate provides some insulation and buffer, and especially the non-traded variety.
Well said. So there's lots of REIT options out there, lots of different strategies. What do you think are the core things that advisors and due diligence officers should be looking at when considering which REITs to invest in or have on the platform?
Yeah. So, for firms like us, we are experts in investing in a particular asset class. For us, it happens to be multifamily. And the ways you invested 5 years ago versus today versus 3 years from now, there's going to be different opportunities. And so looking for a REIT that has the ability to adjust tactics based on the economic environment is super important. I think secondly, looking at the ability to drive cash flows independently of what's going on in the market. So if you own a portfolio of beautiful buildings that look good on brochures, but the only way to drive cash flow is the market is good to you, that could potentially be a dangerous portfolio, even though the buildings are beautiful and they make glossy brochures, because when the economy cycles, you're at the mercy of the market, versus some active management where there's opportunities within the portfolio to drive cash flow independently of what's going on in the economic environment. And so I think those are the tactics and strategies that you really need to look at and understand how does that fit with your perspective as an advisor or as a client of what's going on in the marketplace, what risks and rewards you're willing to take. Sometimes it's the perfect time to buy trophy assets because they have been depressed because we've just come through a very difficult economic time. Those can boom. Alternatively, if we're at peak pricing, those assets can become dangerous even though they're beautiful.
Very true.
Yeah.
Which makes another point for diversification.
Yes.
Among all those things. And REITs, because there's plenty of choices, you can piece together different asset classes, different geographies to make a good comprehensive portfolio. So Dwight, thank you for walking us through the latest and greatest with NAV REITs.
I've appreciated being here. Thanks, Greg.
And thank you for watching another episode of Focus on Alternatives. Again, for more educational content like this, please visit adisa.org, and we'll see you on the next episode.